One of the most common questions I got was, Paul, is the bear market over? Everybody has to realize there are stages to a bear market. I've shown this picture before on how markets work. Now, this is a very simplistic view of how markets work, but it can really give you insight into how emotions drive markets. During a bull market, it feels like it's just going up and up and up. Nothing can stop it. It's just going to go on forever. This sucks people in. Even the people who are afraid to start are the people who are going to eventually get in and really drive us to the high levels. Then what happens? Some sort of capitulation on the top side, and there's a drop. And we experienced that this year. Big drop. Everybody's talking about, oh my God, this is over. It's done. Well, guess what happened? There was a rebound. Phew. The rebound happened. We're all good. Everyone relax. You have everybody sitting there. And this is a lot of has to do with how you look at the average person. How does the average person look at the stock market? Remember, Peter Lynch talked about his cocktail party story. He would sit there and say that he knew where the markets were based on what happened to him at a cocktail party. If he went to a cocktail party and everyone was telling him what to buy, he said, I would have to avoid stocks. Why? Because the average person shouldn't be able to be a great investor. If he went to a cocktail party and he told people what he did for a living, and the average person said, oh, I feel bad for you, he knew it was time to buy. Why? Because people perceive stocks to be a bad place to be. In June of 2003, I didn't realize it then, but now I look back on it and realize where we were. In June of 2003, I was right after college, I was on my training session in Dallas. And it was a bunch of us training for a job. And somebody said in the group, a female in the group said, if you want to make money, you have to invest in real estate. You should not invest in stocks because stocks only get 3 or 4% a year return for the future. I remember thinking to myself, what? No way, that's incorrect. But let's go look at where stocks were at that time. Isn't it ironic? This is 2003, and this is about June, right? So you started to see a rebound already. But guys, look at our graph. You have a peak of the S&P. It goes down. Oh, thank God it's back up. Down. Oh, thank God it's back up. Down. Oh boy, this is and then it starts to climb up. You need to get people out. You need to get people out to the point where that person in the middle of June 2003 doesn't believe because they're like, wait, I was already psyched out twice. I don't believe this is really a rebound. And that's really when the rebound happens. A few weeks ago, I was going at the bank and somebody was asking me what I did for a living. I said, I do investments. And the bank teller said to me, oh, I love stocks right now. I'm buying Coinbase, Amazon, Netflix, and all these Nvidia, all these high flying stocks. They said, are you buying those? And I was like, no, I don't think so. They said, oh, okay. I was like, well, good luck. That to me was an indication that the average person hasn't given up on stocks yet. And as part of the third stage of the bear market, we need capitulation on the downside. That means everybody needs to give up. The average person needs to say, I'm done. I can't take these losses anymore. I can't see my stocks go to zero. This is what happens during bear markets. Just like in bull markets, the opposite extreme of euphoria occurs where you can't lose on stocks, where every stock is a winner. Everybody's making money. When all my friends are saying to me, look at the stocks I bought and how much money I made, that is a problem. Now, does that mean my stocks aren't going to go down? No, of course they're going to go down. If the markets fell 50, 60%, you'd be hard pressed to find anyone who's up at that time. It'd be very, very difficult to do so. But the goal is that if you buy good companies with good cash flows and you pay a reasonable price for those cash flows over a long period of time, you'll be able to dollar cost average. And those ones at the bottom of the bear market are the ones people are going to gravitate towards quality. And what is quality? Paying less money for cash flow and earnings, buying good balance sheets. Those companies will probably drop less than all the other hype stocks. Remember, when stocks go flying up, the most overpriced ones are the ones going to fall the hardest. Just look at the last year and a half. All the ARK investment stocks. There's a reason why ARK investment's down 75, 80%. There's a reason why a lot of companies out there that we said avoid are down so much. Now, those are the easy ones. It's easy for me as an investor to look at the really, really high multiple stocks and say, I would avoid this. Because to me, it's hard for any company to justify selling for 50, 100, 200 times earnings or cash flow. Those ones seem the most obvious. Those tend to be the most high-flying, euphoric stocks that are driven by the retail investor. So what do you need to do as an investor? Well, very simply, learn a process. The process will never, ever avoid mistakes, but it'll increase your batting average, and that's what you're trying to do. Sports are a great analogy to investment. Poker is a great analogy to investment. investments. Why? Because you could have the best pitch, the best hand, but you're still going to lose probably a lot of the time. In baseball especially, a Hall of Famer is still somebody who doesn't get on base 70% of the time, and they're going to the Hall of Fame. Just think about that. With investing, if you can be right 50 or 60% of the time, holy cow, you will go down as one of the greatest ever. The hardest part about investing is the emotional aspect. The hardest part about investing is when this is occurring, that you stay out. As this is going up, you stay out of the high-flying stocks that are causing the big run-up. And as this is occurring, you're buying. These are very difficult things to do. Why? Because as a society, as a species, herd mentality was very important for us in order to survive. So the same thing here. Herd mentality rides you up, and it's hard to avoid that. Herd mentality goes down. I always say being a value investor is being contrarian, but being a value investor is always being wrong. Why? Because you're wrong to the masses here, and you're wrong according to the masses here. Why the heck are you avoiding this? You don't get it. Why the heck are you buying this? You don't get it. It keeps going down. That's the point. Being a value investor, the contrarian part of it isn't just saying, I'm going to do the opposite. I'm going to say the opposite. It's also doing the opposite. It's sitting there and saying, I'm going to value these companies. And by the way, a lot of companies that are falling should be falling, but you have to sift through all the junk and find the few diamonds in the rough. There are 10,000 some companies out there you can choose from. Your goal is to buy 20 or 40 that make a lot of sense, that the price and the value are different. You have to realize that price is what you pay, value is what you get. That is the single most important thing I want you to remember, that you can overpay for a great company. That is very, very important. If you can understand those concepts, you will do very well here. Now, where do I think we are in the current bear market? I think we're currently somewhere over here. We either have a little more rebound to go or we're starting our decline. And you might sit there and say, Paul, you're wrong. I get it. I understand that. And just like people in our community, we have a community of thousands and thousands of investors who are like-minded, who are trying to learn a process. And one of the things I get told every so often, actually pretty much every day, is, Paul, thank you so much. Because of you, I avoided these mistakes. To which I always say, guys, it's too short term. July was up 9%. I was down in July, but I'm still up this year and the markets are down this year. Look at long-term trends. Look at how somebody performs in the long run. Anybody can be right. A monkey can throw darts and be right on any given week, any given day, any given month, even any given year. The question is, who can do well through a full bull and bear cycle? That is what I want you to achieve. I want you to sit there and have the emotional fortitude to do what's right even when you look wrong. It means paying a low multiple for revenue and profit and not overpaying for growth potential. Being okay with a company that grows 2 or 3% a year in terms of revenue because people have ignored it so much that it's super cheap. And as they buy back their shares, you're getting more and more of the company, and eventually the value will be released by people saying, wait a second, that earnings per share is pretty high and it keeps working. Let's go buy that company. That's a huge, huge benefit to an investor. And in our community, when I'm trying to teach for the people who've joined our community, is to sit there and say, if you use a process that either gets you 1 or 2% extra per year or avoids 1 or 2% a year in losses in your overall portfolio, you will crush everyone in the markets. But the hardest part is emotion. That's why we have the community. We have the community for people to understand the emotional side, because being a value investor can be a very lonely road. But when you have thousands of people who are like-minded that can sit there and talk and do research and understand things, you will do much better as an investor. And that is our goal. The goal isn't to sit there and say, oh, this week I made X amount of dollars, or this month I did. Guys, my returns fluctuate every single month wildly. But I'm okay with that because I know when I'm buying, I look forward to red days. Literally, I look at red days the same way the average person looks at green days. I look forward to it more than anything. Why? Because I know that allows me to buy stocks I love, companies I love at the prices I want them at. And there will be a time at some point in the future on this channel when we're down here and I'm saying, there's too much out there to buy. I don't know what to buy. It's so good out there. And guess what's going to happen to stocks? They'll go further south. People will say, Paul, come on, you just don't get it. Stocks just keep going down. I'll be like, well, wait a second. Didn't you tell me that over here? Stocks keep going up. So I want you to sit there and say, if this makes sense to you, if it makes sense that you could be a value investor, just watch more videos. Learn the process. There's no rush. You probably have a long time to go. Even if you're 50s, you have a long time to go because a good value investor will be investing for the rest of their life. It's not just until retirement. It's for the rest of your life. And if you're one of the fortunate viewers who are in your 20s, this will major rewards for you in the future. So if this makes sense to you, I ask you to do two things for me. First off, if you like this channel, subscribe to it and forward this video on to someone that you know. The second thing I want you to do is I want you to watch this next video on margin of safety and how it can get you to do the things I'm talking about earlier. Thank you very much for your time.